Excel accounting practice problem. Adjusting entry, loan payable, short-term and long-term portion. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it if you have access to it. There's two tabs on down below, an example tab and a practice tab. The practice tab starting out where we left off last time, the example tab in essence being an answer key. Let's take a look at it now. We're going to be doing an adjusting entry related to the loan payable, breaking out the short-term and long-term portion, noting that the loan payables can be a bit confusing in terms of how we're going to set up the loan payables and how we're going to be doing this breaking out between the short-term and long-term portions. So let's take a look at it now. When we have the loan payables that are going to be going on the books, it's quite possible that we might have multiple different loans depending on the type of industry that we are in. So our first option when we put this information into our bookkeeping system is to have, for example, just one account that has the multiple loans in it, which would be called loan payables, and then have the supporting documentation such as the amortization table to support the amounts in the loan payable account. However, I would think that most bookkeepers would like to basically, and accounting departments would like to have an account for each of the loans, breaking out each loan separately, possibly having sub-accounts in accounting software such as a QuickBooks, meaning a parent account called loan payable, then sub-accounts for each of the individual loans that can then be shown on the financial statements individually and, if needed, collapsed into the parent account of the loan payable for presentation purposes. As you break out the loan payable accounts, then you would want to make them distinct in nature, possibly calling them loan payable and then giving the last four digits of the loan number, or possibly the institution if that's something that would be a differentiating factor, so you can easily tie in the actual loan you're looking at to the loan amortization table, the last four digits of the loan number often being something that could be a distinguishing factor between the different loans. Then we have the problem of breaking out the possibility of having loans that have a short-term and long-term portion, many loans being constructed or formatted in such a way that they're going to have monthly payment loans, installment type of loans. If they extend on beyond a year, then you could have a current and a long-term portion. In other words, the current liabilities are those which are going to be due within a year. It's kind of like just that arbitrary cutoff. The long-term liabilities are those that are going to extend beyond a year. If you have a loan which you're making monthly payments on that extends beyond a year, the payments that you're going to be making, or at least the principal portion of them for the next year, are going to be short-term. The ones that are beyond the year would be long-term. That would mean that we've got to cut one loan kind of in two pieces to break out the short-term and long-term portion. Now, again, what are the options you could use to do that? One way is you could say, well, I'm just going to take my trial balance, and then when I construct the financial statements, that's when I'll break out the short-term and long-term portion. However, I would generally like to do it generally on the actual trial balance and then just pull the information to the financial statements when we construct it. So I would then break out the short-term and long-term portion of any loan that needs to be broken out. You once again have the same option where you could just make the long-term portion net of all the loans which have a short and long-term portion. But I would think it would be easier to tie everything out and review it if you made a separate account for each of the loans having a short-term and a long-term portion, which you could tie out to the amortization tables and then group them together, the long-term and short-term loans, as you create the financial statements, which we'll see in a future presentation. Once you break these two things out, then you have a problem that it makes it more difficult on the bookkeeper or the accounting department because they like to see the loan in one account so that they could tie that one account to the amortization table when they make the loan payments, which is difficult enough given the fact that there's principal and interest portions that change over the life of the loan. Therefore, we will enter a reversing entry so that we don't mess up the accounting department while still being able to break out the short-term and long-term portion. Okay, so let's do it. We're going to go to the practice tab over here. Well, I want to look at the amortization. So let's go ahead and hide some areas. I'm going to hide first the reversing trial balance. We don't need the reversing entry, so I'm going to hide from AP to AQ. We'll get back to them later. Right-click and hide that stuff. And then I'm going to hide everything until we get to our amortization table. So I'm going to go from the skinny here, going from the skinny all the way to the right until we get to the amortization table, past the general ledger, past the subsidiary ledgers for inventory, accounts receivable, accounts payable, past the payroll stuff. And then there we are. I'm going to leave that skinny right there, right click and hide all that stuff. Hide it. Just hide it. Don't delete it. Hide it. So then we've got our amortization table, and we're focusing in on payment 2. That's where we left off. The second payment was at the end of February, so I'm going to highlight that one. That's as of the end of February when we made that payment, and we're just going to assume that 12 payments are going to be made basically for the next 12-month time frame. So that we're going to count 12 payments up from there. So let's give us some space to work here. Let's put our cursor on the HX, and then I'm going to go to the right and just give us a little bit of working room. Right click and let's insert some cells here. I'm going to make them a bit wider. Let's make these a bit wider so we can work on them. So there we have it. And so notice also that the second loan over here, we're not going to be dealing with that because it's all short term. We don't have a short term and long term portion, so that's not going to be a problem. We're working over here with this amortization table. From a bookkeeping standpoint, it's nice to be able to tie in this one balance, the 69,878, to the amount that's on our books in the trial balance right here at the 69,878. So that's what we would like to do from our basically just a bookkeeping standpoint so that it is easy for us to enter the transactions and not have to deal with a short-term and long-term portion. But we also need to break out the short-term and long-term portion for presentation purposes. So what would be the long-term portion? We would count like 12 periods out. I'm going to count 12 periods up from here. So we could say 1, 2, 3, and bring it on down to 12. With the autofill down to 12 right about there. So that's going to be the end point. So from the green to the green, that's where we're going to go. Then I gotta add up what the actual principal payments are. Now you might say, hey, look, the short-term portion that we're going to be paying is clearly going to be this 1359, which we're going to pay each month times 12 because there's going to be 12 payments. So you would expect it to be 16,305. And that would make sense, except that we're including interest in that amount. And you might say, well, who cares? I'm including interest. I've signed the obligation. I'm going to pay that amount. That should be the short-term portion of what I know I'm going to pay in the next 12 months. But the reason that the interest is not included in there is because it would be kind of like the same thing as if you have an office building that you are working in and you know you signed a lease that you're going to be paying rent in the next year. You're not going to put the rent on the books as a liability now because you didn't actually incur it, even though you've made a commitment to consume the space of the office building in the future. You haven't actually incurred the expense until you consume the space of the office building. The same is true with the interest portion. We're going to pay it because we've made a commitment to do so, but we haven't incurred it yet because we haven't used the money during that time period, like rent, in order to incur that cost yet, so it's not actually a liability. The only liability portion is the balance here, not the interest. So we got to make sure to pick up the loan balance, which is more difficult because the loan balance changes from period to period. So I can't just take one amount of the loan balance times 12. I have to actually add up these amounts on the amortization table, which is somewhat tedious. So we're going to say, okay, that means that the short-term portion is going to be, let's put it down here, the sum of these items are the short term right there. Hold on a second. I didn't put an equal sign. Equals and then sum of these items down to the green. So there we have it. And then if I was to take, that's going to be the short term. And notice my current balance is up here at the 69. Let's actually put this up top. I'm going to cut it and put it up top so we can see it. The current balance is, and let's actually put it, I'm getting picky here, right there. There's the short term. So here's the full balance. There's the short term. And then if I subtract this out, the 69,878 minus the 13,109, we get to the 56,770, that matching the 56,770 that we would be at the end of another year, that being the long-term portion that would be due after that point in time. So that's what we need to break out. We need to break out the short-term and the long-term portion. We put everything into one account, which is basically in the short-term account. So we got to break out the 56770 to the long term, which will make the short term be at the 13109. Let's see what that would then look like over here. I'm going to say, okay, what do we got to do then? What do we got to do? This is going to be on 228. 228. We're going to be decreasing the short term, which is, these are liability accounts. So I'm going to debit it to decrease. Debit to decrease this time. Not always, even though it sounds cool with the double D's. But because this is a credit balance account, we're going to debit to decrease. And the other side, I don't have another account yet. I have to add another account. So I'm going to add another account. I'm going to put it down here because I'm going to indicate that it's in the long-term area. So it's a different kind of type of account. It's not a current asset. It's a long-term asset. So it's going to be after all these accounts, which are all current, sorry, not asset, current liabilities. This is a long-term liability, not a current liability. So I'm going to put it underneath, even though from an alphabetical order standpoint, it would be up top because it's a new category of account. So it's going to be down here. That's what would happen if you were to put it in QuickBooks or some accounting software as well, because you would name it as another type, not as a current liability, but long-term. So I'm going to right-click here. We're going to insert some cells, shifting these cells down. Shift them down. This is going to be, I'm just going to call it long or loan payable. I'll name it number 1, and just call it LT for long-term portion. And then we'll sum this across as is our normal process. And I would do it for any other loan that had a long-term portion as well, but that's the only one that does. So we just got that one account. So now we can use it. We can go down here and say, let's pick that one up for the long-term, for the credit side of things. For the credit side of things, we got the debit. There's the credit side. So then I'm going to indent this. The amount is going to be equal to the thing we just calculated in our amort table. In the amort table, the amortization table. In other words, we want to break out the long-term portion because everything's currently in the current portion. So the 56770, there's the debit. There is negative of that 56770, the credit. Let's post it out and see if it does indeed do the thing that we planned it to do. Let's go up top and see. So we're going to be in cell AM17 equals, scrolling down, picking up the 56770. That brings the balance down to the 13108. Does that match what we have over here for the short term? 13108, 109. It's off by a penny. Rounding errors. I'm okay with that. I'm okay with that. Second half's going down here in the AM22. Got to get up early in the AM to post these transactions. So we're going to say this is going to be the 56770 and enter. So there we have it. So now we've got the 56770 on the long term. Does that match out what we have over here on the long term? It should, and it does. It should, and it does. So there we have it. Let's post it out to the to the GL as well. So I'm going to unhide some columns to do so from AO to OH. Right click on that stuff, unhide. So there we have it. And so I'm going to post this to the GL. So the first one was the loan payable. That's going to be the loan payable here. That's going to be the first one up top. So let's go all the way to the right on the GL. GL loan payable number 1. I'm going to call it ADJ and by BZ. By BZ. And then we're in BZ7 equals left to the wall. Scrolling to the left to hit that wall, scrolling down to get that account, picking up that last account, 56770, bringing the balance to the 13108. That should put us out of balance up top, as it does right there, and we see that that 13108 matches the short-term portion of the loan payable. Then we're going to go to the second half, which is going to be that long-term loan, which I'm going to have to add a new account for. That's new. That's new stuff. So that's going to be the last liability account. I've got this kind of gap right here, so I'd like to kind of use that. I'm going to move this over till we get to that space. So I'm going to just do some cutting and pasting, some cut and paste it maneuver. I'm going to take this, I'm going to say Control X instead of Control C to cut it, and then paste it right there. Control V, and then we're going to take this one, and I'm going to cut that one with a Control X, and put that one up top in here in BY2, Control V. And then we'll take this one, payroll liability, and cut it, Control X, put that right here in BY14 and Control V. Then we'll take the sales tax payable and we'll pick that one up and Control X to cut it. And then we're going to put that up top here in CC2, Control V. And then finally, we'll take the unearned revenue, Control X. I'm going to put that down here in CC14, Control V. Then I'm going to copy this one so that we have the formatting up top where we're going to add the new account. Control C, we're just going to paste it this time. Control V, so we copied and pasted that time. And then I'm going to delete the stuff that's in it. And then in CG2, this is going to be equal to left until we get to our trial balance, the trusty TB, down until we get the loan payable number 1 long term. Enter. There we have our new account. We got the ADJ, and this is in CG 5. We're in CH5, CH5 equals left to the wall. That's not an actual word, but CH5. Where you at? We're at CH5 cell. CH5. Scrolling down, we're going to pick up the 56770. So there we have it. So there's the 56770. I'm going to add that then also to our check number over here. So the check number will check out. Put 2 double checks in the check number. So this negative amount or this red number, double clicking on that, going to the end of it and say plus, putting the cursor back down and picking up our new account. The new account way to the right is the 56770 and enter. That puts us back in the balance again. Back in balance again. So that's going to be it. This is where we stand at this point in time. No impact on the income statement. You'll note down below. Oh, look at what I did. I didn't add the cell to the all the way across for the reversing entries. So when I added this cell up top here, I didn't select the skinny cell. I wasn't careful to add that up. So now I've got this staggering going on here. So I'm going to fix that. The way to fix that, I added this cell here, and then I didn't go all the way across to pick up the hidden cells. So I'm going to select from here to here, AP to AQ. I did that on purpose, of course, just so I can do this demo on how to fix that problem. Not really, but serious. Here we're going to go insert, insert, shift the cells down, and enter. Moving them down, everything lining up once again. Back in balance. We got to copy this one down so that we can be back in balance and I can start singing. Copy that down. Back in balance again. So there we got it. So there's going to be our where we stand. There's no impact on the income statement numbers. We got the short-term, long-term portion. Next time, we're going to do the reversing entry because we don't want our adjusting entry to mess up the accounting department. We're trying to keep them happy as well as get the financial statements to reported the way they were supposed to report. We're trying to make everyone happy here. The bank that wants the financial statements, the IRS, the owner, the accounting department. It's a big task.